In this video, I'm going to show you exactly how to identify and trade order blocks and avoid key mistakes you're likely making. There's so much conflicting information about this, but having been in the markets now for over 10 years, I can honestly tell you that simplicity is better. So let's dive in. We're going to start off with a diagram example and then move to the charts, because of course real life is very different to textbook. The first thing you need to realize is that retail traders do not move the market. It's actually banks, institutions, and hedge funds, because they're dealing with large volumes, like hundreds of millions and billions. But retail traders are mostly dealing with maybe a couple hundred, couple thousand, maybe a few million. And these big players, like institutions, aren't using methods like RSI or MACD. The big players, like institutions, leave a footprint behind on the charts, known as order blocks, because this is where they're actively involved. And I'm going to break down order blocks in very simple steps. The first step is to identify the trend direction. And so in this scenario, it's an uptrend. It's higher highs and higher lows. The second step is to identify the break-up structure, as we've already done here. A break-up structure is a continuation, so higher highs and higher lows, or lower lows and lower highs. Now, before this impulsive move up, we had this pause here, this brief period where price just stopped. And this is what I would call an order block. Now, a demand zone is just a refined order block. And on an uptrend, I would call this a demand zone. Large players like institutions face certain dilemmas. Because they're dealing with hundreds of millions, they can't simply fill all their orders at once here, because there simply is not enough liquidity. Because for every buyer, there has to be a seller. And if they entered all of their orders at once here, a portion of their entries would fill at a much larger price. Also, larger players don't necessarily need to use a stop loss. They often do what we call hedging. So in other words, they might open a long position, so in other words, buying the market, and a short position at the same time. Say, for example, price goes up like this. Well, a portion of their long position is in profit. So they would take profit here. But the problem is a portion of the short position is in an unrealized loss, because they can still hold it up here, right? So how do they mitigate the situation? Well, price went up like this. They take profit on the long position. Price retraces. Well, they can get out of their unrealized loss on their short position and fill in the bids of their first entry to stack even more buys. And the market goes up further again. So this is what an order block. Very simply put, an order block is a period of consolidation, the low volume period before the impulsive move up where institutions are accumulating. Very, very simply put. As you can see, during this first impulse, price paused. So we can infer, okay, if price goes down here again, potentially it could do the same. Now, of course, this is the 4-hour time frame. We wouldn't necessarily enter on the 4-hour time frame. We would refine onto order blocks on the lower time frames. Now, this is during an uptrend. Very similarly, the same concept happens on a downtrend. So during a downtrend, we have lower lows, lower high, and lower low. Now, first of all, again, identify the trend direction. This is a downtrend. The second step is to mark the break-up structure. So I'd mark it like this. Then I would ask myself, okay, before this impulsive move down, where was the period of consolidation? So I would mark it around here. On a downtrend, an order block I call a supply. Of course, I've put the time frame here, but the same principle applies to any time frame. As price reacted here initially, if price goes back up here again, we could get another sell position here once again. And during this whole process of order block mitigation, whereby price pushes down, retraces to the prior supply, and then continues further down, retail traders are concerning themselves with double tops, double bottoms, chart patterns. But again, what happens in real life? Well, in real life, often people draw double tops, but you get a nasty liquidity grab like this, because this is what mass market education teaches. Similarly, mass market education teaches double bottoms like this, equal lows, and then what happens next? Final liquidity sweep and price goes up like that. Now, looking at this 4-hour GBP USD chart as an example, and these principles work on any chart, you can see it's an uptrend. So push up, push down, push up, push down, push up. And this is just focusing on the major swing points. So these points here, and we're ignoring the internal structure. Now, as you can see, the step one, which is the trend direction, is an uptrend. There's high highs and higher lows. Now, moving on to the next part. Where was the break of structure? For me, this was the break of structure. This is the point in which we transitioned and we took out this high. So we want to find the 4-hour demand zone in this situation, so the order block to potentially long from. So for me here, we had this pause before this impulsive move up. And so I would draw the demand or order block for longs here. Now, many people will tell you the demand zone is always the red candle or the down candle before the up move. And it can be in many cases. But I think what's more important to consider is the demand zone for me it's the low volume period or the period of consolidation with low momentum before the impulsive move up. So as you can see, price had this retracement, it paused here, then it had this impulsive move up. Of course, there are better examples than this, but as you can see, this was the impulsive move up. I also like the fact that we've got these imbalances. So in other words, these fair value gaps. So between this wick and this wick, there's a gap here. And this to me indicates it's larger players involved. And so what happened next? Price went back down here and then reacted, and we continued further up, as you can see, yet again, leaving another break of structure. And so just explaining this in very simple terms here, not overcomplicating it. The first step again is identify the directional trend, which in this situation was high highs and high lows. And remember, a break of structure is just a continuation. And so here we can have this push up here, leaving behind this demand. We had a retracement and we reacted here and we continued further up. Now, of course, we don't want to enter purely based on order blocks, and we can actually refine down to the lower timeframes as well. Now let's look at another order block example, but this time looking at a supply. And here we're going to use the 4-hour US dollar Swiss franc as an example. As you can see here, we had this huge uptrend here. Then we started seeing this price action, like this. So this is now a downtrend, because as you can see, this is a push up, push down, push up, push down. Now we've transitioned from this uptrend to a downtrend. So I would label this as a change of character. And remember, a change of character is the same as a break of structure, but the only difference is it's a reversal. Break of structure is a continuation. But again, you can keep it simple, and let's just call it a break of structure anyway. As you can see, price action has shifted from an uptrend to a downtrend. Where would I mark the supply zone or order block in this situation for shorting, potentially? So for me, we had this impulsive move down. This green candle here, this was the period of consolidation before the impulsive move down, keeping it very simple. And of course, if the wicks and the neighboring candles are small, you can always include them as well. But as you can see, this was the point where we had this period of consolidation, this low momentum, low volume price action before this impulsive move down. And we can assume that if price goes back here at a future date, it could potentially react. Now, of course, you don't want to trade purely based on this, but this is just to illustrate the principle. So let's see what happened next. So price went much lower down. And again, remember, order blocks can take a while to get mitigated. They don't have to get mitigated immediately. So price pretty much went in a sideways range for a long time. Then we actually got to the order block and then rejected and then continued further down. But this just shows you how it is respected. And it applies to any time frames, whether it's a daily, the 4-hour or the 1-hour. And of course, we want to check again for the trend. So in this case, it was a downtrend. We transitioned from an uptrend to a downtrend. You want to mark the break of structure or change of character. Then you want to find the impulsive move down. I like there to be at least an imbalance as well. So for example, a gap like this, doing this impulsive move down. And this was the potential point of interest or a zone we can potentially short from in this example because it's a supply. Please bear in mind, every order block has an expiry date. And so in this situation, we've already tapped it or mitigated it. If price was to go back here again, it could potentially go past here. Over the years, I've noticed when people start with these market concepts, they overcomplicate things and mark box everywhere. And initially it can be tricky, but as you gain more chart examples, it will become second nature. And remember, the first step is to find the trend, then mark the break of structure or change of character if it's a reversal, then identify the period of consolidation as we have seen here. So the low volume, low momentum period before the impulsive move down or up. And then you could have a potential entry for a short or a long. And if you found this video helpful, then check out my last video to avoid common trading mistakes.